GTA rents hit $3,000 a month. This is an alarming situation. That is the first article we'll be covering in today's reaction videos on Prime Properties TV. And then the second one we'll be talking about is how CIBC has a new economic insights that questions, are higher interest rates going to break the consumer's back? Stay tuned. Now, if you are looking for some help on how to navigate this real estate market, whether that's buying, selling, or investing in the GTA, you can book a call with me using the link that's right here on the screen. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the Greater Toronto Area, on top of making awesome educational real estate content just like this one for you on YouTube. And if you're enjoying some of the content we like, make sure you smash that like button and subscribe to the Prime Properties channel, because this will help me get that information out there to a lot of people so they can make a right and correct informed decision with the real estate. Thank you. Now, the first article that we'll be covering is GTA rents hit record $3,000, creating a very alarming situation. Very good. As usual, let's say Toronto Star, great headline. Rather clickbaity, but you'll see why it's a little bit clickbaity and not necessarily true. So what they're saying here, and the number that they're pulling, 3,000, is coming from purpose-built apartment buildings. So these are newer buildings, generally not under rent control, and the vacancy rate is very low right now, so they're able to increase the rent because the demand is very high, right? So this is not applying to everything in Toronto, but it is applying in such respect that this is probably the more high-end premium kind of apartment buildings that are hitting $3,000, which is an astronomically high amount, because I'm pretty sure like 2 months ago we were just talking about $2,500, right? So it seems like a lot, but again, you need some context. Now, what they highlight that's important over here is the average growth in rent is about 5.5% in the last 10 years, which sounds about right. But remember, last year we had 22%, and then the years prior to the pandemic in 2018 and 2019 were like about 10% each, right? So this includes kind of the rents being dropped during the pandemic as well. Now, here's kind of the startling thing, and we've always talked about this, we're not building enough, but here's a different way to look at it from a purpose-built rental perspective. So you have here 20,000 rentals currently under construction, which is nowhere near enough, because keep in mind, we have like 1 million people coming in, right? This includes permanent and non-permanent residents, and 40% of the population goes to, Ontario. So it's a lot. Now, there's 116,000 planned units that haven't started construction, with about 40,000 approved for development, meaning that only a third of the planned 116, which sounds like a really big number, is actually approved, because as you know, if it's not approved, it may get kiboshed. So that means that we have 20,000 under construction right now. We have another 40,000 that are approved, and maybe some more down the pipeline within the 116,000, but it's not necessarily confirmed yet. So this is why, in order for us to fix the housing crisis and add more supply, the federal budget, provincial government, and municipal government all have to work together to speed things up, because they're not going fast enough right now. And this is before we get into the fact that we're lacking a lot of skilled trades to actually build these complexes right now. So this is why a lot of this is a very intricate problem. And this is the other thing, the willingness of builders to build rentals, because it has to still make sense for them. These guys are not for a charity, and they're not a nonprofit, so it has to make sense for them to make money. So for the only way for them to make money on this is that the rents stay high, which means I don't think rents are going to come down, or the cost of building that building, or the financing costs, or the capital costs, like interest rates, all that comes down, which makes the profit margins there. And that's only when we can see rents come down. But otherwise, the only way builders are going to be incentivized to build this, if those components don't change, which also kind of includes like the taxes from the city and development charge, then rents will continue staying where they are. There's a whole bunch of things that we cannot control, which is why it's pushing the rents up, and it's almost kind of inevitable, unfortunately. And now what I have here highlighted for you is actually the condo rents, meaning not the purpose-built that they're taking the number from for the clickbait headline, but more so just what the average is. And you can see that the one-bedroom average is $2,484, and like I said earlier, like around $2,500. So it hasn't really moved from like the last time I talked about this. It's just, again, a little bit clickbaity. But again, we'll say there is potential for it to move, because it always moves in the spring and summer market, right? What I found personally alarming is that the studio rent right now is $2,100. That is absolutely wild. Like a studio, like 350 to 450 square feet in Toronto right now is 2,100. Nuts. That's just nuts. And then you got the 2 bedrooms at like 3,200. So what's the conclusion in all of this? Rents are increasing. It's just the unfortunate fact. Are they going to come down? The chances of it coming down are very low because there's a lot of things kind of working against it, right? We're just not building enough, and all the other things I talked about, like taxes, capital costs, and building, right? So this is why at some point, like it may be very unfeasible for people to even be able to rent something in the city, which is why a lot of people have been resorting to like basement rentals. And this is how we have a housing crisis where there'll be more homelessness. And it's a very unfortunate fact in the way that the city is moving towards. Now, the second article that I'm going to be reviewing is more of a report that came out from CIBC, which is some economic insights. I found it very interesting because a lot of people are just following what's happening in the economy right now, that because sheds a little bit of light on how the Canadian household is doing, right? So the title of this article is, will higher rates break the consumer's back? Here's the TLDR. Not really, because there's some surprising insights that they found here. So CIBC has a report here talking about excess cash is actually still on the rise, which is surprising. So there's a lot of injection of capital during the pandemic into households. But what they're seeing right now is that even after the pandemic, you can see right here, it's still trending up. And they're attributing this to a lot more of transfers and the labor market being very strong. So despite the interest rates being high and a bigger portion of people's payments going to interest, the excess cash is still going up, which is actually surprising. So here's another interesting one that I wanted to share with you. They're saying that a lot of Canadians are putting their money into GIC, which makes total sense because the yield curve is all messed up and the GIC in the short term is paying somewhere between like 4 to 5% if you lock it up for a year, which is where a lot of my clients have, and myself, have their money right now. But the interesting thing is that it says that while almost half of the GIC balance is with the redeemable options, suggests that households are willing to sacrifice return for liquidity. Meaning that you're actually getting a lower GIC rate because it's an open one. You can grab the money back out just so that in case you need it, which I also have as well, because in case you need a little bit of liquidity, you don't want it to be trapped there for a bit. It's kind of like a 1-year fixed term mortgage. You don't want your money trapped in for 1 year just because it's like 1.5% higher in your yield. You want that access to your money, which I found incredibly interesting that there's so much of actually people thinking in this manner. And then this one over here, it says that the credit conditions are still okay. Only about 15% of disposable income is set for servicing the debt, which is a lot higher than the norm, which as you can see in this chart down here, but it's still not outrageously high, which is surprising because you would imagine a lot of people need to go service the mortgage rates that are higher. But what I'm interested to see is that a lot of the people are negative amortizing. I don't think they're servicing that much debt, which is probably why I think this number is lower than what it is, because only one of all the big banks is actually raising the monthly payments, being Scotia. And then we have another one here where it says, despite the most aggressive rate hike increase since the 1980s, the debt service ratio is only back to where it was in 2018 and still below 2019 levels, which is absolutely wild. And this is exactly what I was saying earlier. I think it's because of negative amortizing where people haven't felt the higher rates on their mortgages yet. Because if you look over here in the little chart, you can see this is exactly where we are in the debt servicing. When we bring it back down, again, this is where we are. It's definitely not as easy to service your debt as once it was when the pandemic kind of stimulus was there, but it's nowhere near as top as when we were in 2018, 2019 when the stress test came in. And I found that incredibly interesting. Now, what they're saying here is that there's going to be a lot of people who are exposed to the lower rates and they're going to be up for renewals in 2026 and 2025, and that's where we're going to have a lot of problems. But they also suspect that the interest rates are going to be lower, which is going to soften the blow, which again, I personally do believe we'll see rates lower in 3 to 4 years, but if you are kind of on a 1.5% rate, you're still probably going to maybe a 3% rate. So is that enough to maybe break the backs of a lot of Canadians? I don't think so, because as more and more people become aware of this and we have a lot of rules for extending amortizations and stuff like that, I think the blow will be softened. I don't think the banking regulators are asleep at the wheel on this, because if this gets really bad, I think it can get really, really bad, hard recession. And then another chart they have here that I found very interesting is that the amount of credit limit is actually increasing, meaning that people have more money that they could borrow. Now, I don't know how they're coming with that number, whether people are giving them a line of credits and people are taking them for emergency purposes, but you can see that it has grown from this number to here, and same with this chart, it's increased. So it either means that people are paying down their debt because the interest rates are very high, which also makes sense, or they're taking on some more available revolving debt so that they can access it on emergency needed for whatever reason. So it looks kind of like the Canadian is like on a defensive mode right now, whether you're paying it down or getting more revolving debt in case you need it. Very interesting, right? Very interesting. The last chart I found rather interesting is delinquencies will be on the rise as the portfolio quantity deteriorates. So we can see here is with the borrowers, and again, this is probably just like CIBC data, so they're like only a portion of the Canadian households, but it's probably a really good subset that's very similar to other banks as well, right? So you can see over here, you got your super primes, your primes, your subprimes, your primes, and your near prime, right? So on the chart, this is what it looks like right now, and a lot of people are still within the prime and super prime. But what you can see over here is that the super prime and the prime, the percentage in that portfolio changing from last year in like 2021 to 2022 in December has gone down, meaning that the amount of people who are deemed super prime and prime borrowers have gone down. So there's more risk of delinquency. And then as the number of prime and subprime are increasing, meaning that a lot of people may be feeling these interest rates and they're being worked down kind of the credit ladder. And that's kind of where we're going to see a lot of stress. But what CIBC is saying that while there is some risk in the margins, it's not generate a wide enough of a wave of defaults. And this is a similar concept we have in mortgages, right? So a lot of people who have A lenders, outside of Scotia, their payment hasn't really moved, so they're not stressed to sell. But it's the people who are in B lenders who may be like the subprime borrowers or like just maybe the regular prime borrowers, but like they have self-employed income. They are feeling the stress because that type of mortgage is renewing. So this is similar to this concept, right? So we're going to have more and more people work down the ladder and getting like more kind of riskier and riskier kind of loans. And those people are going to probably feel the stress and maybe default. But a big chunk of the borrowers are still in a pretty safe condition right now. And you can see all the excess cash and all the line of credit that a lot of people in Canada have, which is preventing kind of call it like a US 2008 kind of crisis with a mortgage, right? And the final note from CIBC's report is that going forward, however, we expect consumers to increasingly feel the pinch from the past interest rate hikes. 100% agree. Consumption is therefore set to slow meaningfully in the months ahead and delinquency rates should rise. We talked about that, but not rise enough meaningfully to affect the entire market. However, we should avoid a free fall that would require the Bank of Canada to ease policies in the second half of the year. And what that means is if we allow all the defaults to happen so quickly, which will force the Bank of Canada to ease and lower the interest rates so that it can stimulate the economy without going to a crash, that's what we're trying to avoid. So in short, and why I kind of brought this article to your attention is that the Canadian household balance book looks pretty good right now, even though a lot of people are feeling it. But it doesn't warrant kind of the interest rate cut anytime soon. And if there is a cut, it probably means that we're heading into a hard recession. So right now, I would argue maybe they're able to get that soft landing that we're going to see. Like we are probably going to see a recession in the near future, maybe like next quarter or the following quarter after that. But it could be a very soft one that they can bounce off of right after. And I think that's what everyone's kind of gearing for. And this is what it looks like the CIBC data is showing us. So hopefully this gives you an idea of kind of where the overall Canadian household is and how rents are doing right now to give you an idea of what to expect in the summer months. The real estate market right now is booming. Again, I'm going to repeat myself. It's increasing in its velocity, meaning that there's a lot of people going after the freehold homes. Condos are kind of moving, but I still think it's kind of a seasonal uptick. We'll find out more in the summer times as things tentatively do slow down, but we are very much still in a very, very low inventory market and very, very low new listings. That's why there's not much stuff to look for and buy right now. Anyways, if you're looking for any additional help on how to navigate this real estate market in specific to your own personal situation, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya! Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?